Past performance may not be indicative of future results. Therefore, no current or prospective client should assume that the future performance of any specific investment strategy, including the investments and/or investment strategies recommended and/or purchased by advisor, or product made reference to directly or indirectly, will be profitable. Different types of investment involve varying degrees of risk, and there can be no assurance that any specific investment will either be suitable or profitable for a client's investment portfolio. No client or prospective client should assume that any information presented serves as the receipt of or substitute for personalized investment advice from the advisor or any other investment professional.
Welcome to the Bullington Capital Report, hosted by Bill Bullington. For the next hour, you'll receive information on current market conditions and trends that could affect your financial future. If you have a question, you can participate in today's program by calling 216-901-0945. That's 216-901-0WHK. You can also reach Bill by going to his website, bullingtoncapital.com. And now, here's Bill Bullington.
Well, welcome back. Wow. I still don't have my voice back. But anyway, this is Bill Bullington. Recognize me or not. And just glad to be here. Very first week in the year. Pretty awesome. Glad to be around for another year and looking at what financial markets are doing. It looks pretty good. And I know a lot of people get really upset. It reminds me, this guy called in once, and called my office actually, and was complaining because he said all I ever talked about were the positive parts of the stock market. And I'm thinking, okay, so you'd rather that I talk about a lot of miserable things? And the reality is, here's the reality, okay? The way that the stock market is structured, the way that our banking system is structured, at some point in time, you're going to have stocks go up in price just because, just like it's actually the same reasons you have inflation. They're all connected. So inflation is here to stay. It's never gone away. It's actually gone down a couple of times, very rarely, over the past 100 years. And normally it's because you've got a depression going on, or there's an economic recession, a pullback, and everybody's always waiting for that. And like they think they'll be able to anticipate it and make some moves ahead of time. And typically that just doesn't happen. It's not something that is repeatable. If you do happen to get lucky, I've gotten lucky on that multiple times in my lifetime. And fortunately, or unfortunately, most of them were when I was really young. It was a lot easier in those days. And I didn't have a whole lot of money, so it didn't really matter that much anyway. But it's kind of funny. You're better off getting really good, solid strategies, things that you're comfortable with. And that's the most important thing. You just want to be comfortable with doing what you're doing. And for some people, that's going to mean super conservative investments. And, if they see a lot of fluctuation, they're just not comfortable. And if you're not comfortable seeing fluctuation, it's one of the reasons I started talking about annuities, because outside of the stock market, the next highest returns, and these are guaranteed returns, the guarantees are only as good as the insurance companies that are making them, by the way. And there are a couple of agencies across the country that, stand behind insurance companies, especially those that do a lot of annuity business. You have to meet certain requirements, and you're in, and hopefully will be protected when they go down, if they go down. If it ever gets that bad, it's got to get really bad before those guys step in. So anyway, most of the time they're investing the money in conservative things because that's how the insurance company makes money. If they can get a spread because they can make big loans to Fortune 500 companies and charge more than they would charge like a bank, actually. If you can charge like a bank, then you can afford to pay out a lot more in interest onto the products that you're onto your products. And so it's kind of that's a good thing. I'm really happy that I've got the ability to shop around, go where I'd like to go, because there's a ton of, I think there are 3,000 now insurance companies that actually have annuity type products. That's a lot. Yeah, it's probably more than that by this point in time. That's an old statistic. And anyway, so when you're looking at what the markets are going to do, markets over time are going to go higher. Mark my words, they will. And every time I talk about that, I get somebody that gets a little irate and says, markets they're not going to go up like you want them to. And markets don't behave that way. Everybody would love the nice straight line. That's never going to happen. And you know what? I'm kind of glad in a way that it doesn't, because it creates more opportunities. Markets fluctuate a lot, a lot. And I like the fluctuation because when market prices are lower, then the dividends coming in off the stocks, and almost all the portfolios we run, they have dividends. The S&P 500 has a dividend. I don't like all the stocks in the S&P 500. I think there are ways that, I don't just think, I know there are ways that you can make as much or more. Actually, in the long run, you should be able to do better by focusing on stocks that have certain characteristics, like the sales growth. That's a big one. That drives the valuations on most stocks that are out there. And profitability, that's a big one. It's one thing to be able to make money and to grow your sales. It's another thing to be able to do it and maintain your profit margins. So that's a big deal. And if that's what you're focused in on, and there are tons of ways to do that now. I mean, when I first started in the industry, there were over 10,000 stocks. I think it was 11. It was slightly over 11,000 stocks. Today, you've got slightly over 3,000 stocks that are publicly traded. They're not private equity or that kind of thing. And it's a lot more restrictive, but they're typically the biggest, fastest moving, and more profitable than they've ever been. That's another thing I hear or read about. Used to read about it. I think the investing public's becoming a little bit more sophisticated. Actually, they're a lot more sophisticated than they were when I first started. But the profitability, they're always questioning, can you maintain the profitability? And that's always been there. That's always going to be hard. But this is that's the way it's been done. And that's one of the things about competition. Competition brings out the best in everybody. So if you're participating, you have to compete. And the people that actually make the changes are willing to go through the sacrifices. Oftentimes it means we're going to spend a lot of money on research and development. The United States spends more on R&D for the publicly traded companies than almost any other country in the world. China's probably pretty close, but they lie about their numbers, so we don't really know. And I think that's kind of funny too. But starting off, it's the very basics. If you get down the basics really well, then you don't have to worry about a lot of the smaller things. And the basics are just make sure you're in a well-diversified portfolio. It's got stocks, bonds, and cash in it. For the bond portion, you don't need to have. I would stay away from long-term bonds right now. They act a lot like stocks do. Their price movement is a lot, and I know that's difficult to do. You have to do some research on the companies that you're holding the bond funds in, and try to get some ideas to what their philosophies are. They have it kind of easy right now because shorter-term interest rates are higher than longer-term interest rates are, and even if it's flat, who wants to be locked into a bond or a CD for 30 years when I don't think they have 30-year CDs, by the way, but so that's just bonds. But who wants to have bonds for 30 years when you can get a higher interest rate on one that you only have to hold for a few years? Now, the downside to that, or the risk to doing that, is that if interest rates were to go back down under 1%, the way that they were here not that long ago, and you've got nothing but short-term bonds, your interest rates are going down. If you've got the 30-year, they stay where they are. And the price on that bond's probably going to go up. The price is different than than par. Par is the rate. That par is what you get when it matures. Normally it's $1,000. So you buy bonds in $1,000 increments. At par just means you're going to get $1,000 for it. Now some of them, they come out with $100 bonds. I think the financial services industry just gets bored from time to time, and they start bringing other stuff out just for the heck of it. I would have just left it at the $100, but anyway, that's me. The bottom line is that interest rates are probably staying right around where they are, at least for the foreseeable future, and as much as you can foresee, because believe me, anything can happen, and probably will. So that's another reason that you probably want to stay relatively with your bond funds short-term in nature. And why am I spending so much time on this? Well, because most people have 40 or 50% of their money in short-term bonds. And today, a lot of people have a lot more than 40% of their money in short-term bonds. Why? Well, because they don't like the volatility of the stock market, and I get it. I understand that. It's stock market's still, in my opinion, one of the best places to be if you're looking at holding on to that money for 10 years or longer. If you're not looking out over the next 10 years, then forget about it. And when I say 10 years, I mean you need to have the ability not to have to be forced to liquidate those holdings to support your lifestyle. Okay, so this is really important when you get close to retirement. How much do you want available, okay, to go in and be able to get your hands on in a case of an emergency? And whatever that number is, okay, don't put that in the stock market. Whatever you want to keep out for an emergency fund, do not invest that in stocks. It wasn't that long ago, and this is kind of similar. It's not the same though, but we're really just talking about the timing on doing on how you invest the money that you're going to be investing, and not getting caught up in wanting to. Everybody wants to make more money, but most people want to try to make the maximum amount of money they can on almost everything they have. And you just have to take an enormous amount of risk, to do that. And risk it's a double-edged sword. And I remember watching people more than once, and I couldn't talk them out of it. They wanted to put their kids' college funds 100% in the stock market. The kids were like 12 and 13, okay, which means they're going to need that money within 5 years. It's a bad idea. And people go, what do you mean? Look at the stock market. Yeah. Also, look at the peak to trough declines. Peak to trough, what is that? That means where did the market stop going up before it turned down and went down more than 20%? More than 20% is considered a bear market. Okay. And how frequently do those come? And has anybody ever predicted that with a high degree of accuracy? No, they don't. And if they could, this would be a lot easier. I wouldn't have a job. and you know what? At this stage of the game, I wouldn't mind. Yeah, I would love to have that. Yeah, just just give me that 15%er over there. And that's what I would. Everybody would do that. So, bottom line is you got to be aware of those things, and a lot simpler than an awful lot of people make it seem to be, but then it's not so simple that you can't afford to ignore it. And I got about 30 seconds here before I got to take a real quick commercial break. So this is Bill Bullington right here on 1420. If you'd like to call in, the number is 216-901-0945, 216-901-0945, and I will be back after these messages.
Wake up and breathing deeper than yesterday. Take on the morning like your soul's been remade. 95.5, the fish has got you today. Good things are yours to claim, you don't have to wait.
Well, welcome back. Hey, this is Bill Bullington. I'm here every Saturday morning from 11 to noon right here in 1420. Feel free to give us a call if you'd like, 216-901-0945. If you have any questions that you'd like to ask me personally, you can always go to my website. It's bullingtoncapital.com. And our phone number's on there. It's 330-664-0700, but you can find it right on the website. You can also email us through the website. That would be, or just go to, send an email to bill@bullingtoncapital.com. So with that, I was just looking at a lot of the stocks that I'm holding currently and how they got selected. I think it's kind of cool. The basically it's the fund that which I chose from an outside money manager. Outside money manager means it's not me doing it anymore, and which is fine. That's actually I really, to get the biggest returns. Let me put it this way: to get the biggest returns that you want to get, that everybody wants to get, you have to take more risk than most people are willing to take. Okay? And yeah, it works. And yeah, I still have a small amount of money that I still. It's the most aggressive part of my portfolio. And it's done very well. It's also been extremely volatile. I mean, it goes up and down quite a bit. So that's kind of the trade-off. You have to decide, okay, what kind of investor are you going to be? And by the way, you can do this on an account by account basis. So let's say I don't want to risk all my money. Nobody wants to do that. Or at least, nobody that's past the age of 40. But how much risk do I really want to take? How much risk can I take? And how much risk am I going to need to take to be able to generate enough income to be able to retire one day? And as you're younger, you've got a lot more time. You can afford a lot. You can afford a lot of fluctuation, especially if it's something that you're still contributing to. That's even better, because when markets go down, you end up getting more shares at lower prices. And unless the entire system worldwide just busts completely, eventually comes back. And it's the main thing about this country and our economy. Actually, the other countries that are out there, they're catching up. But they got a long way to go. And a large part of it, it's always political. That's the one thing I really can't stand about politics, is how they, it can really affect how an economy goes. You look at a lot of countries around the world that have just a single, mostly communist countries, and nobody wants to invest in their stocks, because they can come in and take everything away from you right away. So the United States is the most trusted in financial markets. Europe's really catching up quickly too. There are a bunch of smaller countries within Europe that have unbelievably strong economies, and you don't hear about that because they're kind of small, and you can't go dumping in all the money that we've generated over here. But anyway, what's really going to help you, by the way, as well as looking at the techniques that they use to manage the stocks, that matters. I like the market cap weighted thing. That's one of the reasons that the S&P 500 is so hard to beat. The Russell 1000, that's the S&P 500 plus the next 500 companies. They're very difficult to outperform. I wouldn't even recommend trying to do that, especially if you don't want to be spending a lot of money on software the way that I do. Even when you do that, I think it's somewhere around $2,500 a month that we spend on that. It's close, whatever it is. It's pretty close to that number. I don't know why anybody in their right mind, other than me, would want to do that. And if I didn't, if I didn't do this for a living, I would not pay for that service. And there are a couple other services that are out there that are a lot less money. I'm not sure how reliable they are. I've seen them. I've taken some test drives on them. I wasn't really super happy with it, so I just stuck to what I have. And it's pretty cool. I like it, and I really like. I have access to institutional portfolios through some of my other providers, and there are literally several hundred of them. Minimally, there might be a couple thousand by now, but because they just keep adding, it's mind-boggling. Anyway, so my biggest account's got 72% of the money in stocks. Okay, so that means it's like almost a 70-30, and it was a couple months ago, and the stock market went up, but a few months ago, and I'm comfortable with that, and I know if the market got hit really, really hard, that particular account is probably going to be down about 35% or so. Why? Well, because it's got more than 70% of the money in various stocks. And when stocks go down, it's not like you can pick and choose which ones are going to go down and avoid the ones that are going down that will stand in defiance. No, doesn't work like that. They all move together now. And it's gotten more and more. They used to refer to that as highly correlated. Correlation just is if this stock moves, will this stock move along with it, and by how much? Correlation on stocks is very, very high, which means that if some of them are going down, a lot of them are probably going down. They all have a tendency to move together in the long run. And now everybody, from Warren Buffett's known this his entire life, almost his entire life. Yeah, his dad owned a brokerage firm and was a U.S. senator, and his grandfather owned a big, I forgot what they used to call them, the big store chain. They were retail, so he came up studying money at a very, very young age, and that's just one of the things that he's always used, and I tried to read a whole lot about him. It's unbelievable that his partner, Charlie Munger, he passed away. I think he just had turned 100, and Warren Buffett's up there. He's over 90. That's amazing. And I thought that age would probably be one thing I could probably compete with him with. Probably not. But anyway. I am amazed at the tools that we have now too. To do what I'm doing, it's mind-boggling. So here's my favorite portfolio. Yeah, I like to take the Russell 1000 and rank them all the stocks in that whole index. Roughly 1,000 of them. And then I like to pick out those that are doing the best right now, that have done the best over the last few months. And I just take the top 40, 50, 60, whatever number I chose for that. And the more stocks that you put in, the lower the returns go, because you're including not just the top 10, you're taking the top 20, 40, and 50, 60, 70, 100. So the more stocks you add, the farther out you'll be when you're using this kind of strategy from just, for example, taking the top 10. I had to learn that the hard way. That's what when I first started doing this, and it was years ago. I mean, literally, more than 25 years ago. And I was one of the nuts that paid for all that software. At that time, it was unbelievably expensive. But I just wanted to be the best advisor I could be so badly. I was willing to make that investment, thinking that I would make that money back up, and I have. But very expensive. And so when you're spending that kind of money, and then you had to learn how to code, that was the real tough part. And by the way, the languages that we used back in those days, they don't exist anymore. They are gone. And so it'd be easier if you were coming up today, because there are a whole lot, the tools are a lot better. And I don't even think that you need to do that anymore, because none of this stuff is actually super top secret. Matching up your personality with the right portfolio is really the trick. Everybody thinks that it's just, well, I just want to make the biggest returns. Well, that may be what you think now, and that's what most newer or unsophisticated investors think, that returns are the only thing that matter. And I'm going to tell you, as you go through life, what you're going to find out is that the volatility mattered at least as much, maybe more. So the amount of fluctuation that you have to put up with, that's kind of a key. You really need to have it's got to be a good conversation. And to think that you'll actually see something coming, I think I can see, I know no, you can't. I promise you, you can't. It's delusional. And I still have a couple clients that think they can do that, and I'm like, wow, I don't really have a whole lot of conversations with them anymore. They get frustrated when, they call me when I didn't see it coming and they didn't see it coming. Why didn't you tell me? Well, because, if you remember back to our first conversations, that's what we talked about. What you really need to do is to focus really hard on how the stocks are being selected. Understand that it's a long-term process. If you're not willing to be in there for at least 5 or 10 years, you shouldn't be in there to begin with. Okay? If you've got money that you're going to need to get your hands on within the next 5 to 10 years, do not put it in stocks. Not a good idea. And what do you mean? Well, if you put it in there and the market takes a big drop and then you need the money, you're going to have some problems. I remember these people calling in who had done this with their kids' college money. They put a bunch of money in the stock market when their kids were, before they were teenagers. They were like 10, 11 years old. And when they needed the money, the market had dropped that year, just their luck. And they were having to take money out of it, and they were beside themselves. And I'm like, yeah, I probably would be too. And that's one of the reasons. Don't put all of your money in. Don't think you can see what's going to happen, because, the potential negative surprise could be extremely costly. Extremely costly. And so, enough with the warnings. It is something you should pay attention to. The good news is that, man, there are so many fast-growing, huge industries right now. And I know I've talked about a few of them, and a few of the fastest growing. Utilities being one, which is mind-boggling. Most people think of utilities as old, boring. Nope. These guys are sophisticated. The demand for electricity has been growing faster than the population now for several years, and could be even a decade now. I don't even know. But the demand for electricity has been growing like crazy. So the natural gas, because of that, because a lot of electricity is generated with natural gas, the demand for that is astronomical. Nuclear is not going away, and they've actually made an unbelievable amount of progress with that. It still scares an awful lot of people. So I think when my generation is too old to do anything about it, they'll probably start using it a lot more. It's scares a lot of people, but that's okay. And now you've got AI is everywhere, and one of the faster growing, industries, I guess. And it's so huge and so complicated. There are tons and tons and tons of different types of jobs that come through with that. And anyway, the bottom line to this is we are going through transitions faster now than we did. I remember getting my first car phone. We didn't even call it a cell phone. It was called a car phone. You should have seen that thing. It was gigantic. And my first portable computer, they didn't call them laptops because you wouldn't want to sit with that on your lap. And was big and was heavy. And I remember thinking, oh man, this thing has, I think it was 50 megabytes. 50 megabytes of storage on hard drive, and that was way more than you needed back then because you couldn't get pictures on, and the internet was all text. It was mind-boggling. So I'm really aging myself here, aren't I? And that's all right. All I know is that it's trained me to think and try to concentrate on those things that are the most important, and that are going to be the most important when you get ready to retire, and things you need to keep in mind. And I've only got a couple of seconds before a commercial break, so when I come back, we'll talk about those things. This is Bill Bullington right here on 1420. I'll be back after these messages.
Light of the world, hope for all men, you never let me down. I'll never be more loved than I am right.
And we're back. Hey, if you hear anything here that you'd like more information on, feel free to go to my website. It's bullingtoncapital.com. There's a contact us page there, or you can call us 330-664-0700. That number again is 330-664-0700, and I'll be glad to look up anything that you've heard that you'd like for more information on if I don't have it right at my fingertips. And so we'll take care of that for you. There's a lot of, it's unbelievable how many products there are now. I remember when I first started in this industry a long time ago, there were 11,000, roughly 11,000. The number was changing all the time. It's always changing, by the way, the number of publicly traded companies, because you have IPOs and you have mergers, and you have companies that just go out of business or decide to do something else. Bottom line is, it's been hovering right around 3,000 now for quite a long time period, and it was 11,000 when I first got in the industry. I mean, it was mind-boggling how many companies and all those financial reports. It was very difficult to find financial reports because most of the research companies only covered maybe the top 10, top 1,500, maybe 2,500 at the most, and so that was really a trip. And today is so much easier. You see it, find out about a company, you can go right to the SEC's website and download all their financial statements if you can find it. I mean, that those things are hard to navigate. It just takes a while. It's a lot of effort, actually. So one of the reasons I still have a job, and you find out how much effort that is, it it makes it a whole lot easier. And the biggest, most important thing that most people they if they have a financial planner or a financial advisor, then they're probably going to think about this, but an awful lot of people don't. And it's basically the question that I've used from the day I learned about this stuff, which was, I think I was already in the industry for a couple of years before this dawned on me, is I went back to look to see how many times the stock market, in those days, S&P 500, went down more than 50% during a bull or a bear market, and I was shocked at how many times it had been down 50%. It wasn't like it was every other year or anything like that, but over a 20-year time period, yeah, at least once or twice, and I'm thinking about that at the time, and I go, man, most people are retired for at least 20 years. That's probably the average retirement now. And to watch your investments drop by that much, it's pretty upsetting. And then that's where you get a ton of these things that come in and say that they'll hedge. A hedge means you're going to buy some insurance on that portfolio. It's going to lower the returns. Well, that's great. Most of the products that I've seen are so expensive to do that you may as well just leave the money in short-term bonds. So that, where do you go? I think it's different for everybody. I know it is. Everybody has a slightly different financial situation. Quite frankly, I haven't seen two people that have had the same financial situation that are exact. Some of them are relatively close, but and then you have the personalities that you have to take into account. If you're not willing to see your stock prices go down by 50%, it probably shouldn't be in stocks. Now, that's Warren Buffett and Peter Lynch both said that. Peter Lynch, if you don't know who he is, it's because you're too young. This guy averaged 30% a year. That is mind-boggling over his lifetime, which I think was 13 or 14 years that he ran the Magellan Fund by himself. Anyway, had these skyrocketing returns, had beaten Warren Buffett during that time period. And so anyway, but it wasn't without a lot of volatility. I mean, that's the only way you can do that. To get exceptionally high returns, you're going to have to accept a lot more volatility. That's why the annuities, I started bringing them out, I don't know, probably 5-6 years ago. And guess what? I'm glad I did. Annuities have, currently, their rates are a lot higher than what I see a lot of people averaging on their stock portfolios, or what they have averaged over the past 10 years or so, especially if you're not adding to those portfolios. If you're at the stage where you're taking money out, yeah, it's pretty spooky. So I would encourage you, if you have any questions on any of this stuff, just give me a call or send me an email. It can be extremely scary, but you put some effort into it and sit down with somebody who wants to find out what you can actually tolerate and what is the best path to go from there. That's where this whole industry should have been right from the very beginning. And I don't want to bore all the young people out there, but when I first started in the business, it was just, it's one of the reasons that a lot of salespeople had, the whole industry had a bad name. You really didn't know. The public didn't know what they were doing. You didn't have an internet, by the way, if you can imagine that. So you had no way to check up on it. And even when you did, you could always have found the information incidentally. It's not like the internet is a magic wand. That information's always been available. It's just that you had to go either spend a little money, but you have to spend more time looking it up. That was very, very time consuming. It still is. That's when I actually build a portfolio, I can't even remember how many hours I spent running iterations, changing one of the factors to it, running it again, looking at the results, running it again. It's a very tedious process. And today it's, what really kind of cracks me up, this part has not changed. This really hasn't changed in the industry. I remember getting advice, and then I tracked everything I did, and people that were below the age of 50 normally were making tons of mistakes and the same mistakes. and they didn't learn. They had to get their head beat in. And then when they got up in their 50s, then they had enough experience to go, oh yeah, don't do that. Okay, so that was, I tracked everything I did so closely just because I was trained that way in the direct marketing that I wanted to see, is there anything I can glean from this that might help my clients and might help my career? And there was. And it's a lot of stuff, and I still see it today. It's hilarious. That part has not changed. The confidence or the overconfidence that an awful lot of people have in their abilities is probably their number one enemy. And so, I put together this questionnaire for being able to try to analyze what your risk tolerance was, and it was fairly simple. And I remember up until a couple of years ago, so for almost 30 years, people were being subjected to these questionnaires. They didn't even know they didn't understand the questions. So how do you answer a question that you don't understand? And that's one of the reasons that the industry itself has struggled. And fortunately for today, a lot of that is gone. And it's pretty easy, and they have adopted that same model. I wish I would have sent that in or copyrighted it. And if I would have copyrighted it, I could have packaged it and sold it. But the bottom line is this. Here's the magic formula. Is take whatever your investment accounts are and start subtracting percentages. Like take 10% off of the, let's just to keep the math easy, let's just say it's $1 million. So if you're down 10%, that's $100,000. You're at $900,000. Are you losing sleep? Now, it depends on how much you've made, how you came across that money. There are a lot of factors that would affect somebody's sensitivity to market fluctuations. Okay, but the bottom line is that's not going to change what you should be doing. If you're upset when you're down 10%, that's going to be tough. I'm going to tell you, first of all, it's going to be tough to make any real money that way. It's a little bit easier now. The short-term interest rates are a little bit higher. But if 10% is your number, then don't put more than 20% of your money in the stock market. Just don't. Find annuities, find CDs, treasuries, things that have guarantees and maturity dates on them. And if you think you can do that, but if you want to make more than that, and by the way, those don't, there's a reason that they only pay between 4 and 5% right now. Okay, that's because there's, I don't want to say no risk. There is risk to it, but as far as most people are involved, are concerned that don't do this for a living, they look at it and they say, oh, well, I'm just going to hang on to it until it matures. So for them, that's no risk. There is risk if you had to sell it beforehand, and if interest rates had gone way up and you're holding some bonds, the fact that they're short term means they're not going to lose a lot, but they would still lose a little bit of money. So even that, and people say, well, but that's a CD. You can't lose. No, you can lose money on a CD. If you have to cash it in early, you can lose money on it. And now they're starting to make corrections for market value adjustments in addition to penalties on interest on CDs. So you just have to be careful. And I guess what this whole thing is pointing to is you need to know yourself, and you need an advisor that's interested in helping you achieve whatever it is you want to achieve. Okay? If they're asking you what are trying to achieve something that they want to achieve, and that happens quite often. You get an awful lot of advisors that sell stuff just for the amount of commission that it pays instead of something that might be actually better for their clients. That happens. It still happens. Not as much as it used to, but it's still out there. And just knowing that somebody's on your side, that's one of the reasons when I left to start Bullington Capital, it was I can't believe how long ago it's been. It's just mind-boggling how quickly that time goes by. But the bottom line was I just wanted to be able to do the right things. I didn't want to be influenced by these companies that would take you on these nice trips, send you on nice vacations, give you bonuses. It was I just wanted to be away from that and try to concentrate. So if that's you, if you're out there and you're wondering, you're getting close to retirement, and you want to develop a plan, and the plans are relatively simple. It sounds complicated on the radio. I apologize for that. But the plans are relatively simple. It doesn't take a tremendous amount of time for me to put it together for you. You get access to institutional portfolios that are managed by companies that manage trillions of dollars, literally. So, yeah, just go to my website and contact us. You can call us, 330-664-0700, or go to bullingtoncapital.com. Or just email me, bill@bullingtoncapital.com. And I think I've got about a few seconds here. I got to run. Have a good weekend. Good luck, everybody, and good investing.
You just caught another edition of the Bullington Capital Report, broadcasting every Saturday at 11 a.m. on AM 1420, The Answer. If you have a question and you'd like to speak to Bill personally, you can call him at 330-664-0700. That's 330-664-0700. Or online at bullingtoncapital.com. That's bullingtoncapital.com.
The preceding program has been paid for by Bullington Capital Management, LLC.